Right, guys, today we're going to be talking about mistakes in crypto trading. The first one and the number one mistake is not having a strategy. The first thing you're going to want to do when you approach trading crypto is establish the time frame that you want to be trading in. Do you want to be a day trader and trade intraday? Do you want to be a swing trader and trade anywhere from over a day to a couple of months? Or do you want to be a long-term hodler? Got different videos on each type of position and each type of investor type and what this might mean for your portfolio. So I suggest you check them out first. Secondly, you're going to want to establish your trading profile. Are you the type of person that trades frequently or infrequently? A lot of us might have jobs or other commitments that mean that we can't spend the whole day looking at pips and candles on our computer, which means that you might be better suited for a longer term investment strategy that's more suitable and more tolerant to larger drawdowns so that you don't have to constantly monitor and have your stop losses get hit. So let's say once you've established your strategy, what's the next mistake you might make? Well, not using proper risk management. Very important to think about the 2% rule here, guys. I made a video on the risk reward ratio. I made a video on swing trading where I really rammed this concept home. I really recommend you guys check that out. The 2% rule essentially entails that you're going to size your positions such that you may not lose more than 2% of your portfolio on any given trade. So depending on how wide your stop loss is, that is going to affect the size of your position. And the width of your stop loss is going to be dictated by the chart that you've drawn and the technical analysis that you have drawn from this chart. If we look at this photo here on the right, we've got some professional traders on Wall Street. And these guys all abide by the 2% rule. In fact, this is a cardinal rule that, if broken, will lose a trader his monthly trading privilege for an entire month. So if that trader loses over 2% of his portfolio on one single trade, he's going to be getting coffee for the entire office for an entire month. If he does it a second time, he's out. That's how seriously these big guys take it. And we need to take a page from their book and abide by the same ethos. Secondly, it's not using stop losses and taking profits. This one's huge, especially stop losses. If you've got an asset class such as crypto with such high volatility and you're trading short time frames where you actually care about drawdowns, then you might wake up, and by the way, especially in a 24-hour market, you can wake up from your nightly slumber and find that your positions are down 20% easily. This is where stop loss comes in and triggers an automatic sell before the capitulation happens while you were asleep. So it's very important to position these stop losses correctly. I will be making another video quite shortly on how to avoid your stop losses getting hit too often. And secondly, taking profits. There's an old saying that goes, nobody ever went broke taking profits. And that's very true. It's very easy to get greedy. I myself have lost hundreds of thousands of dollars, if not tens of thousands of dollars, but I think it's getting closer to the hundreds of thousands now, frankly, by simply being greedy and then watching those paper profits slowly dwindle. So remember, guys, nobody ever went broke taking profits, and you're going to want to trim on the way up. Thirdly, not controlling emotions. Anytime we see a big pump and we see a lot of hype, especially around a particular coin, and all our friends get in on it, it's easy to get FOMO, the fear of missing out. But the thing is, when everybody knows about it, it's already too late. And the fact is, 9 times out of 10, when you're going to be getting on the wrong side of the trade and you're going to be providing liquidity to the people that purchased a day ago, a month ago, a year ago, the smart money. So that's why I usually like to take contrarian bets and like to insert my positions before the hype around the coin has appeared. If you really like a particular project, wait for the hype to die down. It will. No coin will go parabolic forever. Also, revenge trading. It's very easy to get angry at the market. Remember, it's not personal. The market doesn't know you. The market doesn't care about you. If you made a bad trade, don't feel the need to quickly make another trade to make that money back. That's how you sink yourself into a deeper and deeper hole. Sit back, write down the trade in your trading log, and really analyze what went wrong. Was the support broken? Was the resistance broken? Was it a fake out? Was my pattern wrong? Did I just not chart this correctly? And then go from there. Finally, it's got to be falling for scam coins. Always be very wary of when an influencer or YouTuber is peddling a coin. 9.9 times out of 10, that influencer or YouTuber is being paid to do so. So they have no financial responsibility to act in your best interest. In fact, they're acting in their best interest. And many times what they're doing is they've been paid in this scam coin and they're actually unloading their position to the new liquidity, being their followers. So never buy these coins from influencers, and always check the tokenomics in the white paper and the wallet addresses. I'm going to get into this in more videos, but if there's one big wallet controlling a large portion of the circulating supply, like a founder's wallet, for example, it's a red flag. It means they could dump on you. Same thing with the tokenomics. So more videos coming out on that soon. This is just the basics. Thanks, guys.